I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a business that became the best in the world in its category.
Charlie and I were on a plane recently that was hijacked.
With what?
It was hijacked. I'm telling about our experience on that hijacked plane when the hijackers picked us out as the two dirty capitalists that they really had to execute. But they were a little abashed about it. They didn't really have anything against us. So they said that each of us would be given one request before they shot us. And they turned to Charlie and they said, "What would you like as your request?" Charlie said, "I would like to give once more my speech on the virtues of Costco with illustrations." And the hijacker said, "Well, that sounds pretty reasonable to me." And he turned to me and said, "And what would you like, Mr. Buffett?" And I said, "Shoot me first."
Hey, it's Tom here and welcome back to the channel. So just last night as I'm recording this video, I got the chance to sit down and record a podcast with none other than Hamish Hodder from the Hamish Hodder YouTube channel. And that was a really fun podcast. It will be out in the next day or so, so certainly keep an eye out for that. But one of the things that we discussed in that episode, which I want to get into a bit more detail on in this video, is the concept of profit margins. And frankly, the obsession that a lot of investors have with trying to invest in companies that have really fat profit margins that basically take a very high percentage of their revenue home, because a lot of people kind of view really high margin businesses as types of businesses that must have some sort of advantage over their competitors. If the industry average margin is 10% and this particular business is taking home 20% of its revenue as net profit, then surely that is a better business than the company taking home only 10% of its revenue as net profit. And on that podcast episode with Hamish, we actually kind of got into some detail around that idea, specifically talking about the business of Costco, because Costco is kind of a business that does the exact opposite. It has razor thin margins, yet it's still a great business by many people's standards, and it's been a very successful investment for people like Charlie Munger, who's been in Costco since the early 2000s, and also investors like Nick Sleep, who has been becoming sort of more and more popular in value investing circles, having been kind of brought to light a little bit more by Monish Pabrai. Nick Sleep and his partnership also owned Costco since the early 2000s, and again had an absolute home run return from that stock. So this video is probably going to be quite a short one, but I just want to share some of my general thoughts around margins in general. Am I someone that's attracted to high margins or low margins, or margins that grow over time or stay steady over time? I just want to kind of share some thoughts and how I think through that equation as an investor. Now, before I get too deep into examples of specific types of businesses and how their margins perform and kind of my thoughts on those things, I think it is important just to understand kind of some key fundamentals when it comes to looking at profit margins generally, and kind of understanding some of the basic accounting principles when it comes to looking at these things. I know accounting isn't the most exciting topic in the world, but it is the language of business, as Warren Buffett said, which is another actually topic that Hamish and I touched on last night. And when it comes to margins, there are basically two figures that you will often see kind of thrown around. So firstly, on a income statement or a profit and loss for a company, you will generally have two types of sort of profit reported. So firstly, you will have a gross profit, and from your gross profit number, you can derive a gross profit margin, which is basically how much of your revenue you can take home as gross profit. And then you will also have a net profit, and from that you can derive a net profit margin, which is how much of your revenue are you taking home as net profit. And the differences between those two numbers are fairly straightforward. So gross profit is calculated by basically taking the revenue of a company and subtracting what you would call your cost of goods sold. And depending on where you're looking at the financials for a company, whether you're in New Zealand or Australia or the US or some other country, sometimes that cost of goods sold has a slightly different name. It might also be called cost of sales or cost of revenue. But basically it is the cost directly associated with selling that widget or selling that service that you've sold to bring in your revenue. So In the case of Costco, for example, they sell obviously groceries in their stores. They bring in revenue from that, and then they have cost of sales or cost of goods sold or cost of revenue, or whichever term has been used, that basically directly relate to those grocery items. So if they sell a loaf of bread for $1, they may have costs on that loaf of bread of 85 cents, which means their gross profit is $1 minus 85 cents, which leaves you 15 cents. 15 cents on the dollar, or a 15% gross profit margin. Now, in order to get to net profit, basically you take your gross profit, so the amount that you've got left after the costs that directly relate to the item or the service that you've just sold, and then you subtract all of your operating expenses. So these are going to be things like wages and marketing and rent and basically all the other costs that come with running a business. And after you subtract all of those expenses, then you get down to your net profit number. So if we keep working through kind of the Costco example, Costco does actually have about a 15% gross profit margin. So that's typically the margin they make on selling their groceries, in their Costco stores. And if you take off all of their other expenses, so the wages and marketing and everything else that Costco has to pay for in their business, you're then typically left with about 3 cents on the dollar. So that is kind of your net profit margin for Costco, is about 3%. So that difference between gross profit and net profit is quite an important one to understand. With some businesses, you will have a ridiculously high gross profit compared to your revenue. Facebook is a very good example of that, where most of their revenue basically comes from selling ads. And anytime they sell a new ad, they basically have no costs associated with that. So they don't have to buy in any physical goods to manufacture a product and send that out to you. So they really have no cost of sales or cost of goods sold. And basically almost all of their revenue flows through to gross profit. But of course, they still have to run servers and pay staff and so on. So they do have operating expenses, which means that their net profit margin is obviously much lower. So when it comes to the types of margins that I'm really looking for as an investor now, previously I would have been someone in the camp of trying to look for a business that has really high profit margins. And frankly, that would have been a mistake. If I had been an investor in the early 2000s, I would have probably just completely passed on Costco because I frankly didn't get it. I saw these low margins, threw the business out the window, and would have said, they don't have any competitive advantage, and clearly because they're not making very much money relative to the revenue that's kind of coming in the top line for the business. But I have really changed my thinking on that in the last year or so, and I'm really now not concerned with the absolute number when it comes to net profit margins. I'm really concerned about the stability of margins. So with a business like Costco, yes, they have these razor thin 15% gross profit margins and about 3% net profit margins, but those margins are very steady over time. They're not jumping from 3% to 10% to negative 2% or anything. They really have been very, very steady around that 3% number. And that really is what I'm hunting for now. I want to be buying into a business that either has very steady margins, and they don't necessarily have to be high or low or moderate. As long as they're steady, that's kind of good with me. And that really represents to me that the underlying business is able to perform well consistently. And the second type of business that I may look for is one where the margins go up over time. They have some sort of what you might call operational leverage. And I've been burned by sort of the sour end of operational leverage. So operational leverage is basically this concept that as a business scales, they can keep more of their profit on the bottom line. So the model at Costco has always been to give those extra efficiency gains back to customers and to employees. But in other businesses, the larger that company can grow, the more efficient the business can become kind of economically, the more profit they can keep. And, a company like Xero in Australia has been a really good example of that. But at the same time, if you build in operational leverage into your thesis and then the revenue comes down, you can get really burnt by that. And you'll often see that with things like commodity companies or really capital intensive businesses like auto manufacturers. And I was really burnt on that to a certain extent with my investment in Fiat Chrysler, where they were at, say, 3 to 5% net profit margins with bringing in about $100 billion a year in revenue. And if they have even a slight dip in revenue, that margin can go very negative very fast because they have a lot of fixed costs that they really can't quickly eliminate from the business. But then on the other side of the operational leverage coin, you have some companies that have really benefited from this over time. And really software companies, frankly, are the prime example that I've found of this, where they sort of need a certain user base. If there's some sort of subscription type software model, they really need a certain user base in order to get to profitability, because they have a lot of costs to develop and maintain their software and so on, and they need a certain number of customers to cover those costs. But over and above a certain point, as customer numbers continue to scale upwards, the costs are not going to grow anywhere near as fast. And for that reason, you have kind of costs steadily growing and you have revenue growing much faster. You can see this widening gap and this expansion in both your gross profit and net profit margins. In most software businesses, gross profit is going to be very high, because like in the Facebook example, there's no physical goods that they're having to ship out to you, and they're not having to manufacture anything, and each additional unit that they sell is basically costless in many cases. But they do of course have the operational costs in the business, which will get you down to a much lower net profit. And a fantastic example of a business where this has been the case is actually Xero. Xero is an accounting software business, and for a long time they were losing money. They were not profitable for many years, and they copped a lot of flack for that. But if you looked kind of deeply into some of the numbers, and again, frankly, this is one that I just missed and probably should have seen. If you looked deep into the numbers, you would have seen that the revenue was growing much faster than the expenses. It's a very sticky product, and you don't have a lot of customers kind of churning off every single year. Generally, when someone kind of starts subscribing to Xero to run the accounting kind of systems for their business, they don't often switch away. And just in the last year or two, they've kind of reached this tipping point where they've grown their user base large enough now to reach profitability. And I think it's pretty likely in future that their revenue will continue to grow faster than their expenses, which is clearly a very good thing for profitability. And that's a great example of operational leverage in a software business growing out these margins over time. So those are some quick thoughts from me on margins generally. I think a lot of investors, like I say, fall into this trap of really wanting these fat margins. And although in many cases that is a sign of a good business, Coca-Cola, for example, can have better margins than Joe's Cola because they're able to charge a premium for their product and so on, versus other colas that don't have the strong brand of Coca-Cola. I think that it is more about the consistency or even steady growth of margins through something like operational leverage than it is about the kind of absolute number. So hope that was helpful. Like I say, keep an eye out in the next couple of days for the Hamish Hodder podcast, where we got into this topic amongst many other things. But that's it for me for this one. If you did enjoy the video, please hit like and hit subscribe, and I will see you in the next one. Cheers.